You may have heard of strategies of infinite banking on how wealthy people and ultra wealthy people use basically cash value life insurance to basically amplify the performance of their investments, and they're saving at a better rate that they're getting at a bank while also avoiding market risks. Recently, celebrity Waka Flocka basically talked about how he uses it for his finances. So let me play the clip and show you exactly what I'm talking about.
When I know I had all the millions and I didn't even have a credit card, the dumbest. I was like the dumbest person ever. I used to spend money on everything. Man, please. Yeah. Please. I'm going to open up an insurance, put $2-3 million in my insurance, and borrow from that and put it back in. I never lose my money, ever. And anybody get money, will give me a promissory note. Because you go promise to pay this back, I'm gonna bring you to court.
So for those of you that are coming to my channel for the first time, my name is Pascal Manigat and you're watching the Financial Ownership Podcast. Basically what I do is I help people take the 40-year to 45-year goal and help change it to a 20 to 25-year goal by using private banking strategy. And that's actually what I'm gonna be going into detail in this particular video. So now let's get into this. Some of you might be wondering, how is having a cash value life insurance policy really helping him get ahead of his finances? So to really understand this concept, you want to understand the difference between maximum funding a contract and minimum funding a contract. So I'm going to show you a little illustration on my whiteboard to show you exactly what I'm talking about. So there's two ways to fund an insurance contract. There is where you could max fund an insurance contract, or you could minimum fund an insurance contract. And the minimum is set by the insurance company, and the maximum is set by the IRS. So some of you might be wondering, why does the IRS really care about how much people are putting in life insurance contracts? That is because life insurance is tax-free. So they want to limit the amount of money you can put into it, because if it's not taxed, then that's a problem. The IRS isn't really going to make any money off of it. So what most people do is they look at insurance, life insurance, as an expense. So what they try to do is put the minimum amount of money they can put into these insurance contracts so they could save money. So they say you have a $1 million death benefit, let's say, attached to it. Most people are going to try to find a way, how can I put the least amount of money to get this $1 million death benefit? Whereas when you look at banking institutions, wealthy people, and all these type of people like Waka Flocka that I'm talking about right now, what they do instead, in order for it to act as this function of a bank, is they put the most amount of cash they can put in with the least amount of insurance. So basically what they end up is having is an extremely liquid contract where they have money that they could access tax-free. It's very liquid and they're protected from market risk. So the difference between max funding an insurance contract that say it has $1 million death benefit, you actually gonna be able to take out most of the money to contribute, versus if you minimum fund it, you're not gonna have any cash value in the policy, and this is what the mistake people make. So this is when it comes to how you structure an insurance contract. And there's certain tax codes. There's certain tax codes that are available that allow people to use these as a tax-free savings bank. And those tax codes are 7702, 72E, and 101A. Essentially, what these tax codes allow you to do is accumulate your money tax-free, access your money tax-free, and pass on an inheritance tax-free. So once you pass away, you could give a tax-free death benefit to your kids or someone that you care about. And basically, what the advisor or agent is going to do is they're going to structure the contract to maximize these benefits in terms of accumulation, access of money, and also and tax-free death benefit is actually, when you're using it for banking purposes, this isn't the main point that you want to focus on. You want to get the least amount of insurance, which means the lowest death benefit possible. So your money is as liquid as possible. And in terms of permanent life insurance, there's a few insurance contracts that people have. There's whole life, there is index universal life, and there's variable universal life. So these are 3 permanent insurance contracts that are relatively the most popular when it comes to permanent insurance. And really, the only way you could use a concept like this would be with either one of these two, either whole life insurance or index universal life insurance. The reason why you can't use variable life insurance is because it's exposed to market risk. So the way Waka Flocka is using his contract is he's using it more as like a savings bank. So he's using it to save his money, borrow from it, and use it for expenses, maybe business endeavors or investments. So when you put your money in a variable universal life policy, it's essentially the same thing as putting your money in the stock market. So you can't really save your money in the stock market. You invest your money in the stock market. You're taking risks. So I would assume that whatever advisor or agent he has isn't using a variable universal life policy. So that's essentially all I wanted to show you on this whiteboard right here. So there's many people that have used this strategy in the past, and many people you have heard of in terms of business people. The Rockefellers used this strategy in terms of using cash value life insurance. J.C. Penney, Ray Kroc, Walt Disney, all these people that have built great businesses, a lot of them use cash value life insurance as an alternative in terms of, say, investing in the stock market, because they were taking risk in their business and they need a safe place to get tax-free money where they could access it tax-free. It accumulates tax-free and there's no market risk correlated with it. And that's why a lot of people, they use cash value life insurance. And the interesting thing is, before certain tax codes are passed, like the ones that I'm showing you, like 7702, 101A, and 72E, people used to be able to get the same death benefit and also the same amount they're putting in as premium. Some people might be asking, now, why would I do that? Why would I put the same amount of death benefit in the same amount of insurance? What's the point of insurance if I'm doing that? Because essentially, it would be a way to save your money where you could grow it tax-free, access it tax-free, and basically eliminate your fees. Because the main fee when it comes to structuring a policy, when it comes to life insurance, a cash value life insurance policy, is the death benefit. And if you have, say, a $500,000 death benefit and you're putting a $500,000 lump sum, you've eliminated your cost of insurance, and your cost of insurance is now zero, and you have no cost or fees other than the basic administrative fees that might be happening in the policy, but that would be basically nothing. And you'd be able to get all the tax benefits and accumulation benefits of life insurance. But since those tax codes are passed, that I just mentioned, you're not able to do that. But there's still major benefits where you could still use it for banking purposes, similar to the way Waka Flocka is using it. Obviously, not everyone has 3-4 million to put into these insurance policies, but it's all relative to the amount of money you make. You don't have to be extremely wealthy or anything of that sort to have a policy like that. You just have to structure it based on your means. If this concept interests you and you want to learn on how you can implement it in your life, make sure you click on the description below. I have a link tree where basically I have my appointment schedule, whether you want to book a call or ask me a question. And also, if you want a more detailed video on how this entire concept works, I made a very detailed video a few months ago where it basically shows illustrations and spreadsheets on how the numbers would actually look like for someone, say, making 60 grand a year. So if you really want to look at that to see how the average person can use this in their life, make sure you click at the video at the end, that I link at the end, so you can get the full details on how that works. So if you like financial content on how to get financially ahead and improve your finances, make sure you subscribe to this channel, Financial Ownership, because I make videos like this, both long and short form content, to improve your finances. So make sure you subscribe to the channel if you like content like that. So thanks, and I'll see you guys next time.